The election is merely 8 days away, and Bitcoin is back to trading just under $69,000. We are finally going to hopefully get some election clarity and therefore some clarity on where Bitcoin is headed, if you believe that the elections are going to impact that. And I think we all do. I can't wait to discuss this and so much more with the Macro Monday crew, James, Mike, and Dave. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of Wall Street. Before we get started, please subscribe to the channel, hit the like button. Let's get everybody up right now. Good morning, gentlemen. James, we hung out in Las Vegas last week, had an amazing dinner at Don's with Mike Alfred and two of my friends.
It was so good, man. That steak. Wow.
Mike
knows
Alfred,
how to order steak.
Yeah, Mike sits down and he says, show me all the Wagyus you have. He's like, we want all 5 of those. And then he goes, do you want the $1,000 bottle or the $500? Yeah, it was one of those dinners. It was a good time.
And give us a tomahawk.
Yeah, and one tomahawk on top, also Wagyu just for fun. But that's not what you guys are here to talk about. We're here to talk about the most Mike McGlone article in the history of Mike McGlone articles. It was not written by Mike McGlone. I saw this on CoinDesk, and I thought it had to be him. But here we are. Bitcoin has a lot going for it, except the persistent slide in copper gold ratio. Mike, you talk about this a lot, but I had never actually looked at the copper gold ratio and its relation to how Bitcoin trades. But apparently there's actually a very tight historical correlation there.
Yeah, well, I enjoyed publishing on it recently. I've been comparing, obviously, you've heard me compare 60-day correlations between Bitcoin and S&P 500. It's the most ever. It's almost 0.7 on the way up. And even the copper with the S&P 500. So it's usually how that works is these assets, typically copper is really not higher, most of the higher volatility, but typically it'll trade with the beta. And right now we have a situation where beta keeps going up, and these two assets that typically go with beta look fine on a standalone chart, but if you divide versus beta, they're going down. And that to me is the high risk. When you have the high correlations, beta going up, they're going down. And then for copper, you see a key reason why. It's just every day I look on the terminal, I type in NI China or BI China. It's just what you expect. And I look over at bond yields in China. They tell me China's in a pretty severe depression. It's normal in rapidly advancing emerging markets. And so that's why I'm probably publishing, if not today or tomorrow. To me, the next key indicator for all the macro is copper has to go up. The Dr. Copper, the metal known to have a PhD in economics, it did make a new high this year and it failed. Sounds familiar. Bitcoin did the same thing too. Now, Bitcoin, I think, is more of an indication of, risk asset and speculative excesses, either bullish or bearish. But copper, to me, is more of the macro. And so right now it's stuck between about $9,000 and $10,000 a ton. 10,000 is resistance, 9,000 support, and I'll be publishing this soon. If it breaks below 9,000, that's your signal. Dominoes are falling. Now, the election might have something to do with it. It's already happening in China, and it's a key indication is the U.S. stock market just has to stay up. It can't go down, or these two teetering, most notably copper, teetering assets are more likely to tilt lower. So that's why I keep calling it the inordinate burden. I've been using that term for too long. But in terms of commodities, what you're seeing with copper and crude oil and grains and gold, the only one that's really going up and sustaining new highs is a global recessionary trajectory.
I just didn't realize how much people look at that copper gold ratio, even outside of Bitcoin, for the basically global health and appetite for risk assets. Until I read through this article, and I didn't also realize that Bitcoin's best years have been characterized by copper's outperformance relative to gold. Now, obviously, yeah, correlation, causation, of course, right? But it really, I never realized how important copper actually was, even listening to you.
Jeffrey Gunleck, the widely known bond guy, I'm sure James could reiterate on that. Maybe David too. It's one of his favorite things he's watched. But copper's one metal. It does have issues with supply once in a while. And the macro big picture is supply is not keeping up to the global demand you expect in the next 5-10 years. But it's just like the thing I hear about Bitcoin forever. It's so widely known. You have to be very careful when people say it for the bullish case, because that's usually a case that they're kind of trying to push the envelope. The key thing I think for it is I love to look at gold versus a basket of industrial metals, the Bloomberg Industrials Metal Index, and that ratio right now is above the high from 2008. It's at a key resistance. It's breaking out higher. It's not a good sign for the global economy. Maybe it's just a short term with the election, maybe pricing for a bit of a red sweep. But once we get through this election, gold staying strong versus industrial metals, metals weak. From a commodity standpoint, everything I see is global recession. And then I just tilt over to the U.S. stock market has to stay up. And the world tilts that way. And that's why I'm worried if we do get these tariffs that Mr. Trump is suggesting, that makes all these indications for commodities just accelerate downward, copper lower, crude oil lower, gold higher.
I love learning something to start the show. So there you go, guys. Copper, it's straight from CoinDesk as well. Obviously, taking a look at the crypto market quickly, things are ramping up. As I said in the beginning, we're just under 69,000 here on Bitcoin. Ethereum still getting smashed by Bitcoin. Altcoins still looking rough. You know, it's clearly a Bitcoin dominated cycle, and I think that's going to remain the case until we get some election clarity. But it's interesting to me to watch the lack of election clarity, right? We got Polymarket is just booming for Trump, 66 to 34. But then I actually just right before dug up who's favored to win the 2024 presidential election with, classic polls, and it is just neck and neck literally everywhere. I mean, across the board, and we know that it's going to come down to 7 states, and even according to this, that has Harris kind of tipped in her favor for those swing states. Why are we getting such a massive gap from Polymarket, which, by the way, it's not saying that he's going to win by 66% of the vote. It's just saying he'll win by 66% of people think he'll win by at least one electoral college.
The strange thing is, Scott, we polls, your classic polls typically lean Democratic, and
for
whatever reason, especially with Trump. There's whatever reason, people not picking up phones who are Trump supporters or just not admitting it or whatever it is. They've claimed that that they've fixed the polls, that they've fixed the demographics of it, but I'm not sure that they have. And I think that the markets are kind of calling them out on it. And whispers from within each campaign sounds like terrible internal polling from Harris and really encouraging internal polling from Trump. And then when you see the early returns off of the voting that we're getting from the early voting, it's overwhelmingly in favor of the Republicans versus the last 2 elections. So the betting markets are the betting markets. I think they're hard to manipulate because there's a lot of volume there, but it probably has to do with people just calling out the pollsters as being wrong yet again.
Dave, have fun.
I mean, well, there's 2 topics. As far as copper is concerned, Mike's been talking about this for a while. It is the copper gold ratio, and actually Mike's better version of that, which is the industrial metals to gold ratio, is extremely important for understanding what's going on in the global economy. And I agree with him in terms of recession. Where we disagree is the governmental response, which is printing money to try to stop that recession. And that's why gold will actually become self-sustaining on gold, but it will also end up in assets like Bitcoin for a variety of reasons that we could talk about. China being a major one, considering that they're now actually allowing people to talk about the fact that they're stockpiling Bitcoin via mining. I saw a post on LinkedIn from Jim Pressler, and I've seen a bunch of others where the whispers are getting louder and louder that they're kind of articulating this. And it's a fascinating topic that we could dive into if we didn't have the election to talk about. But the election is actually interesting because the Chinese policy as being articulated is repressive in terms of a CBDC for their own people, in terms of control of trade by trying to get a digital yuan to be used in trade. And at the same time, starting to loosen the reins on Bitcoin mining, etc., understanding that as a global reserve asset, it is important for them, just like they've been stockpiling gold, for them to stock, and probably silver, although we don't know that for sure, for them to stockpile Bitcoin. Now, the appropriate response for the United States sounds eerily like one of the parties, which is to have free market approaches to digital currencies, i.e. stable coins, as well as innovation, and at the same time to start stockpiling Bitcoin and understand that Bitcoin as an asset is relevant. And so it's fascinating because geopolitically, that's the obvious answer for the U.S. Hopefully, whoever wins will get on board with that, but it is definitely not priced into the Bitcoin market. It's not even close. I mean, basically, there's like rumors or scratches at the door, sort of priced into the market. 70,000 is irrelevant if Bitcoin ever becomes digital gold. It's 1/15 of where it would be. So it's important to put all these things in context. What we're looking at are squiggles. Now, when you talk about beta is fascinating because one of the things when you run a risk book, is beta is notoriously unstable. Right? Now, what do I mean by that? I mean that a company, if we were talking about stocks that traditionally was a 2-to-1 beta, it could very well go to 1-to-1 or 4-to-1 because of different factors that are idiosyncratic to that particular thing. So when we start talking about beta as if it's this uniform asset that doesn't move in this uniform sort of relationship, that's very misleading. It also doesn't have as much to do with magnitude of the move sometimes. I mean, it's supposed to, as it should. So like when you look at a discontinuous asset like Bitcoin, and I'm sorry for using the math words, but it is, you look at it and you start talking about correlations, you're talking about intraday moves or whatever. But the fact is those 10 days a year that basically correspond to most of the movement in the asset, leaving out the other 240, violate that. Now, statistically, those would just be considered outliers. But since Bitcoin has started and moved from basically $1, zero to almost 70,000, those spurts are what determines price discovery. And so when people ask me, what do I think about this going on about Bitcoin? It's that I think that we're stuck in a range until we move into price discovery, and then all bets are off. And so everything we're seeing, everything we've been talking about for 9 months now, it has been inside of a trading range. What will get very interesting is, will Bitcoin actually break the range and get to price discovery? And so I don't think that has a thing to do with beta. I think that has everything to do with the narrative that's driving global supply and demand forces. And, we've talked about that. So I just want to put that in context. But what I think is the most important thing that I read over the weekend, what is really fascinating, is what James wrote. And so I'd like to hear James talk about the bond market and the fact that bonds at the 10-year bond at 4.25 after a 50 basis point rate cut. And what does that signal, for the global economy? And what does that signal for risk assets? Because frankly, you took the time to write it, James. I took the time to read it, but I'd rather hear from you about it.
I appreciate it. I mean, yeah, if you look at yields across the board, they're up. And so people are kind of confounded. The Fed just cut rates. The Fed is cutting rates. Why would rates be going up? And the simple answer is all roads lead to inflation. That's the simple answer. The more complex answer is you're seeing a few things going on. So with the prospect of a Trump sweep, a Republican sweep, and possibility of getting both the House and the Senate, that could leave spending pretty much unchecked. Even if you do have Elon coming in and trying to shuffle the cards around, it's still going to it still could leave spending unchecked. That's one thing. The second thing is, we're just seeing continued deficit spending, and it's not getting better. You have to log in, Scott.
I know, dude. It's not working because it's long story.
So, anyways, but we're seeing continued deficit spending. We're seeing better numbers than expected, and worse on the inflation side. Inflation just stuck somewhere around 3%. And the job number's okay, but it's fiscal driven, and people know that. And so what's happening here is you've got some uncertainty. The uncertainty is, where do rates go in the future? Because the Treasury is going to have to slide out on the duration scale here. And Mike will, I'd like to hear what Mike has his thoughts on this, but I just don't see how they're going to continue to be able to issue, floating rate debt in the T-bills and short term without eventually having to slide out onto this in the duration scale and start issuing bonds, 10 years and 10 years, 20 years, not so much, because it's not that interesting, but the 30-year. And so now you've got the 30-year at 4.5%, which means that the mortgages are stuck up over 6%, 6.5%. I mean, like people are expecting more inflation. They're expecting, and whether it's driven by the economy, a strong economy in the future, or it's driven by just pure the issuance of debt and the need for continued QE at some point in some sort of quasi or real yield curve control eventually to keep those rates down. It's going to be inflation. Like all roads lead to that reality. And until we see something different, rates are going to continue to gravitate higher because of two things. The investors want to be paid for that interest rate risk, and rate premiums are on top of it, not because people think that the government's going to default, but they will soft default through expansion of the money supply. And that's just reality.
It's interesting. We have two articles, one from Bloomberg. American wealth will grow either way under Harris or Trump, survey shows. And if you dig in, a lot of it has to do with what you said. And Bitcoin's going to 80K regardless of Trump or Harris win. Right? So the only path, Mike, is up. There's no other choice but up, no matter who wins.
Yeah, so we hear that there's an issue, but one thing I want to disagree with Dave, because I don't disagree with him. There will be continued fiscal and monetary stimulus, but the bottom line is never forget what the catalyst typically is. What caused the U.S. to bottom in 1933 is when we debased. You got to usually have a little bit of pain in risk assets for that to really accelerate. The problem is, as Ira Jersey pointed out right now, we're just spending an extra $2 billion a year, 6 to 7% of GDP. That's unstoppable at the moment. But the key thing, trillion, yes, right? Ooh, B and T, forgot it. But the key thing is, markets right now pretty much price for a red sweep. And to me, it's more likely we're going to get Harris presidency and a Republican-leaning Congress, which is a natural check and balance. Anytime they try to spend, they're going to say, oh, we're going to regain that austerity they had during Newt Gingrich, the old contract of America. To me, that's where we're going. But the bottom line is, to me, all roads actually lead to deflation. This is where James and I can disagree, because right now we're getting inflation, a pickup, but in history, all the lessons of history is when you pump that much liquidity into a system, and then you dump, which those get to deflation. And also, I'll mention two books. The Price of Time by Edward Chancellor points it out, clearly happening in China. The Price of Tomorrow, Jeff Booth pointing out the massive amount of techno optimism that's happening. It's a word I learned this weekend from reading the book Power and Progress. But to me, this is, first of all, from a commodities bias, obviously, very deflationary forces. Nothing but going that way. U.S. average gasoline price in this country is about $3.13, expected to be below $3 within a month or two. That's typically the time of year it does. U.S. average diesel price is around $3.50, expected to go to $2.50. And if it's not works out that way, it does not work out, who to blame. The average cost of production for crude oil in this country is $56 a barrel. Well, still $10 above that. But I need to put what James said in a global context. Bond yields in China, the 10-year yields 100 basis points less than the U.S. Okay, so maybe it doesn't matter. If you look at the top 5 countries in the world, China's 200 basis points less than the U.S. The top 5 countries, their average, including India, is 100 basis points less than the U.S. So yes, the deficit's a problem. I've heard it every single day. I've been in this business since the 80s. The problem is everything might change in a week. So we have to kind of be careful, see what's going to happen with that election. If we get the red sweep, I think James is, and that reflation story is more likely to play. But if we get the check and balance, which Americans are famous for, remember what happened in the midterms? We got a little bit of check against, it's always the way they do it. And not always, but typically, then we have that thing that I'm worried about is the dominoes for deflation are accelerating. China, Europe, Canada, Germany. And there's one key trigger. Well, we had a lot of tariffs, so all these people like to export to US, that's a problem. And or if we just get a little, I've just never seen a time in the history of the world where the market, the whole world's more dependent on the US economy and US stock market staying elevated. And we're just overdue for a little bit of 10% correction in S&P 500, which right now on a market cap basis is would be the most related, most effective, and most pressure on GDP in 100 years because it's 2 times GDP.
The funny thing is that if Trump wins and we get a complete red sweep, that's what I think would give you your 10% quick correction, to be quite honest. Because if this red sweep is priced in, then you sell the news, right? I'm not saying that it's bad for markets. I'm just saying that would be the trade, the natural trade for anyone who watches markets say, hey, we're going to get a 10% correction when the thing we think is going to happen finally happens.
So I think there's 2 points here. First, the market's not pricing in anything. It's just not.
I disagree with that.
I mean, the market is kind of leaning in a direction. Yeah, but no. I mean, it's not. I mean, I think that it would be. I would actually be surprised if, in fact, there was a red sweep, if the market didn't sell off big time from people who are terrified about tariffs and mistake Smoot-Hawley for what's actually being proposed and don't understand the difference in global GDP dynamics. The fact that the U.S. was a producing nation when Smoot-Hawley went in, and we're now a consuming nation, which is a vastly different scenario and probably deserves some unpacking. But I'm going to blow through that for a second. And completely underestimate what will actually happen in terms of tax policy and deregulatory policy, et cetera. And so, yeah, it wouldn't remotely surprise me to see a crap stock market for, a quarter or so until Trump is inaugurated and people actually see what the real policies are, because there's going to be protests in the street. There'll be all the people hand wringing. I mean, just look at the rhetoric. I mean, the one thing that's bothering me about this election, and the reason why I think it's that it is your scenario is almost impossible, Mike. I'm not saying that Harris can't win, the Democrats can't win. I am saying that it's unlikely to be the way that honestly might be the best for certainly for the mainline legacy financial markets. Is the rhetoric on the Democratic side has just gotten to a level that's actually turning my stomach. I mean, when a comedian speaks and that's all people talk about, when you're getting all this Hitler and fascist stuff, it's like, I mean, come on. I mean, enough already. Let's talk about actual policies and actual things that matter. And, that's why the politics is just such a dirty game that I can't stand it. So I don't want to worry about it. But what I do think matters and what is very relevant is, this notion of unchecked spending, the place where we all agree is, at least in the beginning, there is going to be money printing. There's going to be deficit spending. And the real question, for this show, for our listeners, is how does it impact crypto markets? And how does it impact the newer financial system? And I think that it's pretty interesting, because it's pretty obvious that will be unleashed when, you can't say the market is pricing it in when you'd have a actual Bitcoiner as VP, another Bitcoiner in the administration, RFK. Trump's son is a shitcoiner. Actually, all of his sons are shitcoiners.
Musk,
Howard Lutnick and Elon. It's not priced in. People who want to jump in and push the button, and considering my personal circumstance, I'm extremely aware of this. I have probably talked to 2 or 3 dozen people in the industry who are waiting to make changes and policy decisions on their own in terms of direction of their business because of the election, and they have not pulled the trigger yet. So no, I don't think it's priced in. I think that it's leaning in that direction. Absolutely. I think that pharma companies, if it was priced in, big pharma prices relative to the rest of the S&P would be getting hammered because of those proposals. But I don't think any of that is priced in. So I just think it's important. But could we get or will we likely get a Trump fear trade based upon tariffs? Yes, absolutely. I think that's a highly likely scenario. And in that scenario, the trade, for those who really want to put it on, are buy U.S., domestic oriented companies and domestic manufacturers and sell multinationals that have outsourced a lot. You want to find a sneaky trade. There's a lot of research to be done there. That's the trade to put on if you really want to see a Trump win. And that trade is not working right now, because it's definitely tilted smaller cap, and small caps have not outperformed. So it's worth looking at that. But
James,
I think there's a lot to unpack.
Yeah, we have sort of this consensus here that, of course, markets go up if Harris wins, market goes up if Trump wins. Okay, that's Bloomberg. But we do here in this panel believe that both will print money regardless, right? And that the path is the same regardless of who it is, kind of the Spider-Man twins pointing at each other. That said, Trump has floated the Elon Musk Doge, Department of Government Efficiency, which Lutnick has been talking about as well. Is there even a path to cutting costs enough for it to matter? That's my question. Because if you're over $1 trillion,
you have to ask that question in 2 parts.
What candidate hasn't said that in history? Oh, we're going to be
years.
more efficient.
No. I mean, you have to ask that question in time, because the answer is yes.
Okay,
if you say over 4 years, but the answer is no within the next year.
Yeah, but hold on. I mean, the answer is, look, we've got $2 trillion of deficit. Where are you going to cut it? I mean, you've got, your mandatory expenses are over $4 trillion. So, I mean, are you going to cut out every single thing that is not, that you're going to cut out defense? Because that gets you up to $5 trillion. You were taking 6.9 trillion. So either if Mike is right and we have a deflationary event, it only gets worse.
Yeah. The simple fact, Scott, is I've been saying, politics aside, now let's push politics off to the side. You and I have talked about this multiple times over the years. The only way out of our debt trap, there's only one way out. And I don't know that we'll make it. I don't know that we can get escape velocity past the black hole.
Inflate.
It's a combination of two things. It's inflate financial assets, and it's unleash productivity by deregulating in a massive way. That is the only
outgrow our expenses.
Now, there is
what Dave is saying is create the situation where each dollar that you borrow creates more units of productivity, which is not what's happening right now. It's going the other way. So you got to reverse that.
And I am not
where
saying
70% of the defense budget goes. Yeah.
The simple fact is, I have no idea whether or not either party has even the slightest chance of doing that. Although obviously the Democrats want to regulate more, so that's kind of off the table. But I'm not saying that will work. What I'm saying is that is the only possible way. And, to get back to natural 3 to 5% GDP growth, it's not these little fits and starts and things, actual reflating of the manufacturing economy, actual, innovation unburdened by enormous amounts of government regulation. And by the way, both candidates. Forget tariffs.
Do that. Could tariffs do that in the United States? If tariffs were so high, we actually started producing everything again in the United States.
I want to talk about tariffs separately, but no, this is about deregulation. And to be fair, Kamala Harris has actually said this as well. Unfortunately, her party probably let her do it, but she's made the point that starting a business is too much red tape. And yes, that's true, but we have a federal government which has strangled innovation in this country, except for the fact that it strangled it less than in Europe, which has been completely strangled. But compared to Asia and other areas in the world, we're lagging. Now, I don't know if we can grow our way out. This is not a pom-pom exercise. That's the only way. And Elon Musk certainly understands that, because he's been saying virtually the same words, recently. You've heard about it. So, but those are long-term things. You don't wave a magic wand and increase productivity. That takes time. So in the short run, a lot of what might actually help could actually be deflationary in the sense of, we could have some serious problems, or inflationary in the sense of we're just going to print too much money. And as James said, it's not going to go there. The point I'm going to make about tariffs is, it depends who you listen to. If you listen to J.D. Vance or you listen to Trump. If you listen to Trump, it's across the board. It's narrative-based nonsense, which if you did a lot of what he said that says he's going to do, would be destructive, right? Because it would decrease global trade and for no purpose. If you listen to J.D. Vance, what he says is we have very specific decisions to make. We opted to hollow out the American middle class. And how do we do that? We allowed every multinational company to do regulatory arbitrage, to basically say the cost of doing business in the United States for environmental rules, worker protection rules, and other rules is much higher. So better and the most famous example of this is steel, by the way, where originally it went to Japan, which the cost for wages was more or less the same as ours, but they had less rules and regulations, and then that's of course moved to other places. The simple fact is, I'm saying simple fact too much. When you look at tariffs and you look at what you're trying to do with tariffs, if what you're trying to do is reestablish parity in terms of regulation, in terms of the things that we believe matter in terms of the environment and protecting workers, and if you're looking into reestablishing, some sort of wage base, probably not a horrible idea. It's just a question of there are trade-offs. It will certainly lower standard of living, because we've been importing a better standard of living due to this. And so these are trade-offs that you can make. This is not a hyperbolic, Smoot-Hawley causing disaster.
At least short-term likely be inflationary,
What?
What do you say, Mike? Short-term be inflationary.
Absolutely.
Yeah, prices of everything would go up. I mean, there's no question about that.
Now, let's remember something. And here is which comes down to the thesis, my core thesis. There's two types of inflation. There's monetary inflation, which really goes to assets, and then there's consumer inflation, which takes into account supply chain.
This would increase consumer inflation.
That's right. And that's what people care about. So that means it could be a rocky road in the beginning. It might work, and it might be a better ultimate answer.
But there is no tariffs, money printing, whatever. There's no short-term gain without massive pain. There's no changing the system in any direction short-term that doesn't cause a lot of pain, unless you just stay on the same unsustainable path indefinitely. I mean, James, and then Mike, tariffs. Tariffs, cutting expenses. Is there any path here that's not just massive inflation or money printing, or I should say inflation of the money supply?
Well, those actions are not, like Dave said, if we could cut expenses that are not productive and start creating expenses that are productive and create an expansion of true productivity, that would be positive for GDP. It would be positive for our debt issue, our deficits. That's the question. Can we do it? I think there are paths to do it. Absolutely. But then you turn around and you've got the balance of that, which is the tariffs. And, tariffs will be inflationary. There's just no way around it.
That's right. And that's why, curiously, despite having completely different ways to get there, Mike and I end up in a very similar place, which is which is a beta sell-off in the markets. Where we differ is specifically to Bitcoin and to assets that will likely be freed sooner rather than later from what has been a very, very hostile government. And so that's why it's really important to delink crypto. There is a very real possibility of a delinking of macro from crypto initially, because we faced it. I mean, read anything that Caitlin Long has written and any of her entreaties to Musk and whatnot about how hostile the government has been to, her enterprise and others. And I was talking to, I've talked to a bunch of people over the last couple of weeks at conferences who have talked about just how incredibly bad Operation Choke Point has been for crypto. But do not underestimate the best campaign. I said it when it happened. I mean, Scott, you had a great back and forth with John Reed Stark a couple of weeks ago, and he gave the best Trump ad ever. I know he didn't mean to, but he did. And his friend Scaramucci probably was unhappy with it. But the exact quote from John Reed Stark was that all of the SEC enforcement actions against crypto companies if Trump wins will come to a screeching halt. Do not underestimate the impact of that on crypto assets. Can't. And so that has nothing to do with the macro. I mean, it's macro in a sense because it's obviously an overarching theme, but that is what I'm talking about. But I think, Mike's point about, global economy being, whatever, and you start introducing tariffs, you introduce these other drags on the economy. There's a lot of risk there.
Mike?
Well, yeah. So my trajectory from commodities. Obviously, it's not playing out in the one major country, and that's the U.S. So I look simplistically. We are near multi-year lows, 6-year lows in VIX volatility index, 200-day, 50-week moving averages, very low volatility in the U.S. The highest stock market measure, some people said 97 percentile versus price earnings a year from now, but very expensive stock market. In that environment, we should get a little reversion at some point. Typically takes a catalyst. I've been early, I've been wrong on some things, but that's why I look at the U.S. Treasury market as basically a put without decay on just a little bit of normal backup in stocks. The question is how long does it last? It's just overdue. And so I look over, I'm still really bullish gold, but I fully expect my base case is Harris will win. We'll have that check and balance, and then gold might drop $200. It's overdue. In big picture, it's still in a massive, pretty substantial bull market. The key thing I like to point out is in this environment, unless you think things are different, unless you expect beta to keep going up, overweighting risk assets like like Bitcoin or cryptos that typically have a much higher volatility than beta, is typically are typically underperform. Yes, I'd love to see that divergent strength. I'm not seeing anything right now that's like I see copper and beta and Bitcoin just the last 6 months or so trying to inch up higher with beta. So to me, that's the key thing. And everything right now is political. Dave mentioned to ignore it, but I know you're kind of kidding. All that matters is what happens on Tuesday the 5th. If by the next day we have a definitive change of power in this, and what I'm hearing globally is that point that we might be somewhat leaning towards the end of the American Republic. I've been reading a little bit too much history lately. So that's what's pricing in the gold market. So everything is about what's going to happen. But the bottom line is we're looking at, in terms of cryptos, highly speculative, very risky assets. And now the mainstream's in it. We've got the ETFs. They've launched. They're done. We have to look forward to, okay, now they're going to be buying more. Great. But all that big stuff we can point out forever. That's why I keep tilting over towards gold and treasuries, and that's where, to me, the next key indicator is going to be copper. If copper breaks down, it means the dominoes tumble.
Interestingly, pivoting to Bitcoin, we now have in the options market, popular 100K year-end goal for Bitcoin has less than 10% probability in the options market, and actually it's even a relatively low probability, although higher, that it gets to 82,000. So it seems that people actually putting their money on this bet are not as excited as the Standard Chartered and pundits of the world who thought it was a foregone conclusion that we would get to 100. I mean, go ahead.
It's not priced in. I keep saying not priced in. Repeat after me. It's not there. People are not putting their money on it. Remember, I've made this point many times, but I think you're about to see it play out in force. Bitcoin over its history in every bull run has been led by speculators. And if the speculators don't get follow through in the spot market, you see an immediate crash, right? So we saw, if you remember last summer, we saw from 25 to 32 on the announcement of the BlackRock ETF. Now that sounds quaint right now, but that's a big percentage, move, right? And it failed, and it did it again and again. Then the ETFs got approved, and it moved up into this 50 to 70 range. And as it moved, there were
after going 46, 49, 39.
Correct. The speculators during all this time have gotten basically, it's the old hit on the nose with the newspaper. And you do that enough times and they don't do it anymore. And so the amount of upside speculation is really, really small relative to Bitcoin's market cap, probably the smallest it's ever been.
Which is ironic considering the amount of tailwinds that we have, regardless.
Well, but that's right. So every time you expect, just look at your mentions. You dared mention Bitcoin was pushing up against 69, and there was this little teeny tiny wiggle.
It's
in
69 right now.
Yeah, I understand that. Yeah. But when you said it, there was a little red candle down to 68.7 something or other, and somebody chided you. And I'm sure, and I'm not picking on the person because it doesn't matter. I think that a lot of people felt it. Like, how dare you say that? Like, if you put out your tweet 69,000 all day, like you're almost certain to do.
I'm doing it right now while we talk.
There will be a bunch of people say, "Oh no, you're jinxing the market." It's like people are the speculators are just so used to having it collapse in their face. The real question is, are these demand drivers going to show up, and will there be supply to sell it to them? And if you believe that the answer to that is yes, by all means, bet your chips on it. If you're more like most of the people in the market, the vast majority of the traders in the market want to see confirmed breakouts before they put their money in, right? Yeah. They want to see it. And that's why you have this dynamic. It's really fascinating that and incredibly healthy. Markets climb a wall of worry. Right now, nothing has changed. I am no more, euphoric at 69,000 than I was despondent at 51,000.
We might be really euphoric above 70 or 74.
Well, at some point, euphoria becomes when, I'll tell you when euphoria happens, not when the price is that. No, the price will be there. Euphoria is when Microsoft or other big companies with huge cash stockpiles say, crap, I need Bitcoin on my balance sheet. And you start to see, instead of 3 or 4 companies putting Bitcoin on their balance sheet, you start to see 300 or 400. At that point, you start to see that's a sea change. Those are the sorts of things that matter. And that's the demand drivers that would cause this dichotomy to resolve itself. And the dichotomy is,
James, in your mind, what are those? Like, I agree.
Well,
with
I mean,
Dave
we
that
saw
corporate treasury
Microsoft
be catalysts.
Yeah.
What would be the other catalyst? Obviously, I think central banks.
That is on definitely out there. But we saw Microsoft announce that they are having a vote on this December 10th. They're having a vote whether or not to add Bitcoin to the balance sheet. Now, it's unclear exactly who pushed that, but a large shareholder clearly pushed it, in my opinion. And so now the board has recommended against it. They said, we recommend against this measure. Here's the problem with that. And people are getting excited and, they want, they want this to be approved. With the board recommending against it, it just becomes very unlikely it becomes approved. And why is that? It's not because we're just going to say, the board says no. It's because typically small institutions, family offices, your small pension funds, firefighter funds and police funds, they don't go in and do the research themselves. Typically, they just have their proxies voted for them by agencies that do this for them. And Mike, what's the biggest one? The biggest proxy vote? Anyways. They just go and that proxy vote goes along with the board because it's a cover your ass thing. It's just like, well, the board said no, we're going to go with the board, and so it's not likely to be passed. But this is the significance of it is that it's on the docket. It's being considered. It can't be ignored now. It's being considered, and so the boards can no longer say, "Oh, that's nonsense. We're not even going to bring that up to a vote." They're just like, "Okay, we'll bring it up to a vote."
It's like the years of ETFs getting filed and not approved and filed and not approved until there's enough groundswell that it pushes through and it happens. I think that's what Dave was alluding to. I don't think this time it's one more company. I agree with him. And I don't think this time if it becomes a strategic reserve asset, it'll be one central bank, right? Exactly. I mean, this is when we're really, I think, pushing.
Now you're talking about gamesmanship. Exactly.
Yeah.
Game theory. If I don't do it and they do it, then I'm left behind. And so
Mike, aside from obviously the stock market correction, we've talked about this before, but central banks, companies adding it to the balance sheet, are there any of these catalysts large enough that in your mind, you could see a major decoupling and to see it, fly regardless of what's happening elsewhere? And we have talked about it, but
if you're right, James and Dave, about corporations adding it to their balance sheet, absolutely, eventually. But here's the key thing: as I was thinking about that, is corporations have had a chance to add gold to the balance sheet for 5,000 years, and they really choose U.S. Treasuries or their local T-bills or local interest rate instruments. So it's a major leap, I guess, in technology to go to Bitcoin. I can see a little bit, but the risks of being wrong for a board means you get fired. It's like, okay, maybe 1% is not a big deal, but people use numbers. So that's the key thing I'm concerned about is, well, if they're going to just jump for Bitcoin, I mean, central banks buying gold makes sense. And then it's like a third reserve currency now after the euro, after what's happened in China. But corporations, it's a whole different story. I mean, I can see the techno-savvy ones, obviously, MicroStrategy, sure, but the rest of the world, and you're talking about some very stoic, conservative, accountant-type people.
I agree. The personal risk is too high. The professional risk is too high at this point. But what you just said, Mike, is what's so key about this, is that if and when a board does add this to their balance sheet, and in lieu of treasuries, that is the significance right there. And when they do that, that tells you that they're storing their value somewhere else. And that is mind blowing, but that is eventually where we're going unless something changes, unless Bitcoin just never does catch on, unless Elon solves the deficit issue and we're now super productive with every single marginal dollar that we borrow. There's at some point, and I'm not saying this in the next 6 months. I mean, like this, it is going to happen at some point. And the significance of them choosing it over a treasury that's where it's like, okay, now it's a different story. It's not just adding gold. It's something.
It's a
different.
simple fact of high volatility, highly speculative risk assets versus U.S. Treasuries. Sorry, but when you're a fiduciary, I just look back and like,
I know. Yeah,
you just don't do that. But the thing is, I only hear it from Bitcoiners. That's the only people who say it. Otherwise, you're rational people who are not in the space. Like I have to mention, the last few conferences I've gone to, I see a lot of money showing stuff. I see a lot of gold everywhere, but I don't see a lot of Bitcoin and cryptos, because this is more traditional. People are making a killing in the queues, and until they stop making a killing in the queues, they're still going to be their focus. Yeah, we're getting the trickles, sure, but it's just, that's the key thing. I mean, I point out, I know Dave will push back. It's almost 4 years now that Bitcoin's just underperforming queues, and like, okay, at some point it might catch up, but that to me is the point: is we're due for a reset. Yes, I've been early. I've been wrong. We're clearly seeing a global reset in commodities. The key question is, after the election, we're seeing it in the rest of the world, definitely in China, definitely in Germany, a lot of Europe, Canada. Is it going to happen in the U.S.? And if it does, that's where I point out, just, it's time to underweight risk assets, and there's a time to overweight, and that's sticking with gold and, well, some bonds, some point bonds. But I know, James, you push back on that one hard.
Mike,
yeah, I would not own long-term bonds. I just wouldn't, not right now. It's just that the risk reward isn't there for me. I'm not shorting them, but then,
Mike, let's say we get the quick correction, right? That we don't get the 30-40% that we've historically gotten, because as Matt Hogan said, recessions are illegal. Let's say we get a 10% correction from November to February or March, right? And then things start heading back up. Do you agree that the next 4 years could just be yet another up cycle, and that could be enough correction? Do you think they can kick the can far enough down the road?
It could. It depends on who's in power. It depends on, but historically, it's been proven that that's not when you want to overweight risk assets. We still need something to shift and change, and we haven't seen that. Now, we're seeing in China, the second largest economy, seeing most of the rest of the world, obviously in commodities. But that's the problem, is I keep pointing about this. I started writing about it in February, about the test. When are we going to get a test? And we got a 5% correction in S&P 500 in most risk assets, particularly Bitcoin, dropped a lot more. We had the 10%. Most risk assets, particularly Bitcoin, dropped a lot more. But they came right back. It's wonderful that we've outlawed recessions, which is one of those, it's the things I've been hearing lately that's
one of those comments, of course. That's the topping signal type comment.
It's like the quote, I tweeted it on this weekend. There was a famous person point out that some people are looking at the Magnificent Seven as a store value. There's crypto people, I hear it all the time, they look at SPYs as a store value. These are the kind of things you hear and you remember from the future, and you say, yeah, that was a sign that I should have been staying in gold.
Dave's got the tracking going on. I was like, did the green screen go with him? I couldn't figure it out.
Yeah, I didn't check. Sorry, just had to run out for 2 seconds. I mean, I heard what Mike was saying, and I think
he heard all of it.
So
just a beat.
Look, the simple way of looking, my mental model of as Bitcoin as an option, which I'm not going to go into, is, will we get to that level of acceptance? Store of value is, the better word for it is denominator. So the dollar right now is the denominator for the world, and that explains why the U.S. rates are higher, because it's the denominator for the world, right? There's no rational other explanation for Greece having lower borrowing costs at 10 years than the United States. There just isn't any. And so my mental model says that. That mental model extends to the fact that for 5,000 years, gold was the denominator for all financial assets. And in 1971, with a stroke of a pen, Nixon said, no, it isn't anymore. So from financial assets have been depegged from gold since 1971. But buying power, purchasing power, and gold have still tracked pretty well if you look at purchasing power parity. Price of a suit, price of a this, price of a that. And so we've seen this delinking of financial assets from consumer prices that has been massive, right? And there's always these snarky tweets of, well, what happened in 1971? Because you see all this, but that's what happened. Yeah. And so we literally have been, our careers have all been in a regime that in global financial history is microscopic. Right. So from 71 to 2024, 53 years is the fiat regime. Before that, there was only little tiny instances of fiat currency because as empires basically blew apart. There has never been this before, a global fiat regime. And so what I believe, my mental model is that and I don't want to be hyperbolic and talk about death throes and fourth turnings and global everything, but the fact is the crack up boom is my most likely scenario for this reason. This fiat regime, and I don't think it's coming to an end anytime soon. I don't. I do think that the pre-shocks of it coming to an end will be, massive asset inflationary bubbles serially getting bigger and bigger over time.
I mean, that's the telltale side of the fiat regime, right? Is bigger business cycle, bigger crack up booms, bigger depressions.
Right.
But that kind of supports Mike's theory that recessions can't be illegal, and eventually the bigger recession or depression comes, right?
Except, but what Mike isn't telling you, and I know he knows this. I know. James,
what are you hiding, Mike? What are you
no,
hiding?
Mike?
I want to hear it. Dave, tell me what I'm hiding.
Major recession that actually takes out the underpinning and confidence in the regime would be disastrous.
Exactly.
And that is exactly what the government all are terrified of.
That's it.
And will do everything they can to keep those nominal numbers as high as possible. And that's why there's a desire for inflated financial assets to decrease and hopefully to make that prioritizing capital to once again keep a lid on consumer assets. That's the issue. And so, it's a mental model. I understand it is what it is, but our disagreements have much more to do with that than me saying, oh no, you're looking at the chart wrong, because he's not looking at the charts wrong.
Mm-hmm.
So you basically, we have to be careful saying it's different this time. I look at very simple measures. We all know unemployment always 100% chance goes to 6%. I love pointing out that since 1979, crude oil's always fluctuated around $40. It's probably heading back that way. And if you look at the gold, the S&P ratio, it almost gravitates towards 1-to-1. Right now, it takes over 2.2 ounces of gold per one S&P. I'm sticking with gold because it's heck, and particularly if you head towards recessions, unless it's different this time. It's how long we can keep this Ponzi scheme going is my point. And that's why
That's what impressed me the most.
Yeah, well, exactly. It's going, me too. Gotta admit, it's happening. But again, we all know it's with the massive deficit spending in this country, which we know is good for Bitcoin, but I think it's better for gold. And that to me is what I'm worried about by still, that gold's going to prevail. And it's just when we have this normal period when the S&P 500 doesn't make a new high every single day, maybe for couple years, just something that we all grew up with that used to be normal, that this is looking to me just like one of the most speculative risk asset bubbles in history. Bitcoin led the way for good reason. And now the fastest horse in the race might be leading the way the other way. I'm just pointing out those simple facts and pointing out the good alternatives, and it still remains gold.
Well, it doesn't mean you shouldn't own any Bitcoin in your portfolio. That's the point, is that you have to have your core. Agreed. And if you're going to trade around it, great. My viewpoint is super long. So then, but honestly, Mike, if I wasn't on a Bitcoin standard in my hedge fund, I would borrow money against long bonds. I would short long bonds and buy gold not in my hedge fund, but I would be personally buying Bitcoin and borrowing long-term bonds. But that's a longer term trade for me. It's not like just overnight, but it is a longer term trade for me. But since I'm on a Bitcoin standard, I don't need to borrow in dollars. I would have to sell Bitcoin to effectively do that because of margin. That doesn't make any sense. But you understand what I'm saying. Yeah. Right. So
James, but this was the sort of inspirational tweet for your newsletter. I mean, what do you think Powell is thinking when he's sitting there at cut 50 and mortgages are back above 7%? What's he thinking?
Well, he's obviously wondering if the market is thinking that he's made a policy mistake, or if they are hammering treasuries because of the U.S. Treasury, and not really U.S. Treasury, but the U.S. government.
So fiscal dominance, Lynn Alden.
Exactly.
Nothing
So
stops this
what's
train.
next? What's next stage for the Fed? If there's any problem, they buy bonds. They always have.
They will buy bonds. They're going to continue to lower rates. The question is at what rate? That's all. What is the terminal rate? So what we've seen is the market's adjusted the terminal rate from being 275 or 280 back up to 350. Since before the Fed meeting, which is really interesting. Now you've got one more thing that's coming up. I know we have a few more minutes here. We have one more thing coming up, and it's Wednesday. We've got the quarterly refunding announcement from Treasury. And so what are they going to do? Well, this is a really weird time because you've got the quarterly refunding. This is the last one we're going to have before the election and before the end of the year. This is it. So what are they going to say? And are they going to just kick the can down the road again, not raise the amount of paper issuance and just keep issuing? Dave just didn't like that. Keep issuing the floating rate T-bills and just kick it down the road for an eventual, if they really believe that Trump is going to win, it doesn't matter, and that again, but the Treasury is not really political. Technically, they're not. They're just trying to do the very best they can from quarter to quarter and decide just how much they can get away with the short-term paper issuance. There's not a lot left in the reverse repo. You got $200 billion left, right, Mike? I mean, that's it. There's not that much left drawing out of there. So,
Mike,
once
it's
that's gone,
I know.
I mean, it's not catastrophic. I don't mean this is not alarm bells catastrophic. Oh my God, the market's going to melt down. No, it's just it's another signpost for the Treasury to say, okay, well, now we got to start getting. We're going to have to start getting borrowing from somewhere else, and that means moving out on the curve, likely, right?
That's Mike's alarm that copper just broke out. I hear it.
Yeah.
So that's the thing, though, is that you've got that going on this week. So it's going to be interesting. I don't think there's going to be a big change. I think the big change would be the Fed to come out and say, okay, no more QT. Like even $25 billion a month isn't that much, but no more QT. That's just the mental significance of it, right?
Mike, quickly, it's funny. We have these articles that say up no matter what, right? Harris wins, everything goes up. Trump wins, everything goes up. But to be fair, if you're looking at this historically and the way that you are, everything goes down either way at some point.
Well, it's also, I always like to look at something I started decades ago, looking at where's the relative positioning, relative sentiment, where's the market relative to its normal means. And I know Dave makes fun of me sometimes, and we make fun of silver going higher, and silver going higher is not going to the mean. That's an extreme when silver goes higher. So it's just, we're so extended and there's so much optimism. It's when you lick your finger and you hear or you just go in a room and you hear the complete optimism. We've seen these things before. I just see it on the charts. I see it in commodities. Obviously, I'm a commodity guy. And I see nothing but global recessionary trajectories. And I just look at Bitcoin as it's the wonderful trading vehicle. I agree in the big picture, but I think it's also a great leading indicator. So the macro to me is, yes, we'll see what happens on the election. Everything right now, we can just use all the words we can. I just pointed out how expensive risk assets are. Yeah, keep going up. That's great. Bitcoin's part of that. And gold is actually getting a little expensive short term. But it's really going to be all about this. And this is potentially most, if we trip to a red sweep, it might be the most, we might look back at from history as the most significant elections in our lifetimes. If we get what happens oftentimes in the US, you get that check and balance, red Congress and Harris as president, first female president, then that's going to be probably the normal check and balance but we'll say overall, as you point out, everything is so just on a complete upward swing. You just got to be careful.
Here's the check and balance that we're not going to get if we have a red sweep. And the last part of information that people should have is that we currently have no debt ceiling. Now, not that we would have a real hard debt ceiling either way, but there's literally nothing stopping, those two branches, that branch of the government, the congressional branch, from just deciding what they want to spend. I mean, that's where I agree with Mike. And but the point is that either way, you're talking about the same thing, which is a crack up boom or a sharp deflationary event that requires a mass amount of money printing to counteract it because of the current fiscal situation we're in. Again, I just want to caution people, because we talk a lot about this stuff, and then I don't think about the US dollar's demise over the next 18 months. It's not what I'm thinking about. I'm just thinking about the inflationary pressures that are inherent to the current situation that we're in. Because of either way, either you have nominal GDP that's just rising because of fiscal spending, or you eventually you just have money printing because of the need to continue to assert yield curve control to counteract it. I mean, that's what's in my mind.
I'm just so excited for this election to be over.
Mike, you're on mute.
Yeah, Mike muted. It looks like he had something awesome to say too. So
I think the key word for you and everybody is relief, and hopefully it's relief. Hopefully it's not contentious, because we all know if Trump doesn't win, I'm sure he's going to push back and say it was fraudulent. Which is, oh gosh, please. But we'll see. It's going to be great to have it over with. Yeah.
No, it would be nice to have either way. It looks to be pointing more like it would be more likely to be a red sweep, and it would be very difficult to contest, or the other way. I mean, it's just that I just hope it's not contentious.
I love watching the mental meltdowns in the chat, though. It's become my favorite part of the show. My ADHD kicks. I will say once again, this show, I could rebrand it Echo Chamber, and we could just bring in 4 people who agree on how high markets are going to go every single week, if that's what you guys want. But, I think having measured opinions backed by data and experience are probably what we want here. So you're prepared for anything. Literally, Mike, you say that Harris could win, and people freak out as if that's a controversial opinion. Guys, it's an election that polls are saying is kind of 50-50-ish. Doesn't mean she could. It's not a crazy statement to say that either person could win the election.
No, it's my base case. I think your typical Republican, like I am, will go down, look in their ballot, and pick Harris because they're just concerned about the risks of losing a Republic, and then go Republican the rest of the ticket. The vast majority of this country are female and Democrats, and there's an alternative to the discourse of violence and the potential unpleasantness. We might have a Trump 2.0. Every single, 50% of his ex-cabinet members have pointed out at War with Ourselves by General McMaster pointed out that Trump 2.0 is not just a regular president, it's a complete autocratic leader with a bunch of yes men. You see that in Vance. So that's what I think people are going to look back down at and say, okay, maybe push back on that. That's my sense of the population. And remember, I'm from a Trump state. I'm from Illinois. I'm from the Corn Belt. And that's my sense. A lot of Republicans are using the quote behind the scenes, crazy man. That's what I'm hearing from.
Yeah, listen, either way, I'm definitely hoping in 2 weeks that we're having a conversation about what things look like moving forward with President. I'm not going to get political. Whoever it is, that we do have a non-contested election, and that we're moving forward analyzing what the likelihood is for markets in the future. We've been talking about this a lot.
Yeah, it would be time to move on. And it's funny, Mike, because here in Nevada, which is a purple state, in 2020 saw a lot of we saw a lot of Biden signs. I'm surrounded by Trump signs. Yeah. Surrounded. Like I've seen one Biden sign in the 3 neighborhoods around me. That's it. Like it's interesting. So
yeah, there's a lot less. I was saying to my wife actually the other day, there's a lot less political posters in general than last couple elections around me.
It's contentious.
Yeah. Where I live, it's mostly Trump posters, even though actually my county votes blue in Florida because of the University of Florida. But generally, just very, very few signs. It seems like people have just kind of given up.
I think we're all ready for this to be done.
Yeah. One last piece of news that I just wanted to share. I don't know if you guys saw this. We talk about Polymarket endlessly, but Robinhood just added presidential election markets.
Really?
Yeah. So that's 24 million funded users on Robinhood. I don't know if we're going to get enough clarity in a week, but this could be bye-bye to Polymarket in my mind as far as relevance. If Robinhood can actually get some traction with their markets. Oh, guys, 10:06. Dave imploded. I don't know what we said, and he finally disappeared.
Green screen swallowed him.
The green screen ate him into the bathroom behind the green screen. But that's all we got for you guys. Listen, next week we're going to be talking election tomorrow.
Oh God!
And a week later we'll be saying what happened in the election 5-6 days ago. It's going to be pretty wild. I would macro election Monday.
Yeah.
All right, guys. Thank you so much. I always appreciate the banter and the opinions. See you guys soon. Bye.
That's dope.